Vikas Khemani, good morning. I was being told that you would be joining us in the studio. Office तो बस across the road है.
I didn't know that. Sorry, maybe my mistake, misunderstanding.
इतना तो बारिश में कर सकते हो यार, across the road
I
है.
would have loved to come, but I just missed it. I didn't
Okay.
realize.
Next time we shall come to your office. That's a much better idea.
Sure, most welcome.
What's your view on the market? I mean, enough and more has been thrown at the market in terms of global cues, local views, valuations, budget, but markets are strong. Why is that?
That clearly tells you the underlying, economic momentum in India continues to remain very strong. So liquidity continues to remain strong. So where both of these obviously drive the markets in short term. And fortunately, frankly speaking, other than stretch valuation, there's no other argument for being worried. So I guess and India is the only market around the globe which is offering such a great promise and sustainable growth, medium to long term. So I do believe that markets will remain buoyant. Of course, given where we are, the expectation from the market from this year's perspective, I feel should be kept low. There might be time correction, there might be some bit of value correction, but it is unlikely to be any time like last year. So keep expectations low, but hold the portfolio for long term. I mean, I'm not worried. On Indian markets from a medium term to long term perspective. Short term, there could be a bit of a correction from a time and value both perspective.
You like to stay to the same set of winners and same set of leaders, or is it time to churn now?
Again, I think investing is all about, in my opinion, medium to long term. If you are invested into stretch stocks, stretch segments where a lot of value has been captured in, probably time to get out and move to stocks or sectors which are offering value or interesting risk rewards. And that is what, as a portfolio manager, we do all the time. So, we never invested into consumer stocks over the last 5 years, but first time we started, last couple of months have been buying, good consumer stocks where there's a good, risk reward and values offering. So I think same way I think you could see in pharmaceutical sector, same way you could see in some of the chemicals. So I think it again boils down to the portfolio construction, your style, your time horizon. And that is irrespective of what market you are in or what level. I mean, you have to keep on looking and doing that. And especially, I would say at this point in time, frothy sector should be paired. Frothy stocks, should be watched with caution. And in any good market, especially in markets like this, fads tend to become very easy. People tend to chase fads, and that is a risk I would say avoid at any cost.
Sure. So, Vikas, given that you are foreseeing, some amount of correction at least in the short term, and while nothing changes in the medium and long term, in light of that view and how the, budget vision has been, have you made any changes in your Bharat Amritkal fund?
Really, I mean, like again, we invest with a very long-term perspective. I don't think anything has changed in the budget from a India story perspective. If at all, there are some segments probably would have got better. So it's a continuous process, and budget has been only progressive budget from a furthering the sustainable economic growth of the country and removing the inefficiency, bringing transparency, creating providing support to MSMEs, agriculture. So I think this all direction, same right direction. So our view has continued to remain positive structurally, and I think that doesn't change. So we haven't made a single change, to be honest, from a budget perspective. Yeah, but we continue to remain invested.
And also, to the pockets of exuberance that you were earlier highlighting, Vikas, what is the messaging out there for a short term investor? Should they be completely booking out? Are the best of the gains behind us for the year?
I mean, short-term, long-term investor, any investor, exuberance should be avoided at any cost. If you think stocks are trading 100 P, 20, 120 P, 80 P, and with the sort of limited growth, a lot more execution risk is always ahead. In any industry, there's always execution risk. Keep in mind what kind of execution risks are there, whatever hypothesis you have. So, and typically you will find very high execution risk in the frothy stocks where there are fads. Your opportunity looks very big, but most often investors underestimate the execution risk, and that sets the disappointment. And when the disappointment comes, then everybody wants to sell at the same time. And this is a typical thing which happens in every segment time and again. And I would say, so evaluate in light of this particular, execution risk format, and then look at. I mean, I can't advise, but for everything with one broad brush, but each stock specific one has to relook at and revisit.
Vikas, morning. So, would you think a prudent strategy would be at a time like this to maybe even park a substantial amount into the defensives, the pharma, the FMCG basket as a whole? What's your outlook there?
Again, we don't necessarily churn our portfolio based on what is defensive. We again look at when you are investing from 3 to 5 years perspective or even longer, what you're looking for is, identifying good quality companies, good managements, and which can deliver the, 18 to 20, 25% kind of returns. Now, if in this markets, there might be some aggressive players which you might get, available at a reasonable good price, you don't mind buying that. I would only say that in this market, one thing every investor should do is take the risk parameter multifold. Examine every risk, 10 times more than what you ever examined maybe 3 years ago. Because in the times like this, you start overlooking risk because you start believing a lot more possibilities. As you do well in markets, as your portfolio is doing well in market, you start underestimating the risks. And I would say that every investor should, rather than defensive versus, one has to constantly only up their ante on the risk. And as long as you do that, I think, one should be fine.
Because where do you think some of the so-called popular PSU names are headed? I'm being repetitive with this one now, whether it is defense or railways. Where are they headed? I mean, if somebody is owning them, is it time to switch? Is it time to still ride, or is it time to move out?
To say again, I can't advise you broad brush across all sector, but there are pockets which are, I think, doesn't make sense to remain invested. And I'll give you an analogy, or probably I'll take you back. Say 2020 or 2021 was a great time to invest into chemicals. But by the time, Jan, Feb, March 22 came, everybody was so bullish on chemicals that, especially every, commodity chemical company started positioning themselves as specialty chemical company. And, there was exuberance. And post that, you saw almost 1.5, 2 years of no return. And in fact, many stocks became half. Now, chemical as a sector opportunity for 10 years remained very promising, very good. No doubt on that. But there was a period when you kind of went through a big pain. So similar things is happening in defense and railways, where long-term opportunity is definitely very good. But many of the stocks have been kind of, reasonably very well stretched. In fact, today, a company which does not do anything in defense has 5 times defense word written in their presentations. Or, I mean, I met a company where total defense exposure was 5 lakhs rupees, and they were kind of talking in the meeting so much of defense. So point is that these are the kind of typical bull market, fad driven stories you get to know, and you have to be very careful on those. Those are the ones definitely to be avoided. And wherever, I mean, there are times when the next 4 or 5 year story or growth is already captured into the, what's the point of remaining invested? I would rather go from a risk reward perspective to the sectors where I have a better risk reward than remaining invested to that. So I would say that you can't broad brush answer for a sector, but there are many stocks in those two segments you mentioned which are on an outlier side.
Would you also club EMS as well as the energy transition theme along with defense and railways, Vikas? Or do you still think that there are opportunities and the stocks are not already pricing in next 3 years of growth there?
I think AM is also in one segment where I would completely agree with you. Just think about it. It's a great opportunity, no doubt about it. But how does a 5, 7, 8, 10% EBITDA margin business with single digit or early digit ROE justify 80 times P, 70 times P, 60 times P? Anybody who kind of senses this, let the company grow at 30%. But point is that, will you make, if you hold for 5 years, will you make money? You might make money in that momentum, and that, I don't know when people will be able to get out, but if you can't justify those kind of things, right? So same thing is happening in EMS as a space where, quality of the business, people have stopped, looking at. I mean, how does 4-5% EBITDA margin justify 80p and with poor ROE? So this is happening right now. So I would say that that's when I was saying that keep your risk antenna basic back to fundamentals high. In markets like this, you have to kind of constantly do that again and again.
So what is good and what is cheap in this market?
Like I said, we've been buying consumer. We still like IT. There are very interesting IT companies doing at 30%, 25, 30% available at 25, 30 times. So, we like specialty chemical space where I think a lot of corrections have happened, and I think good promise as the sector seems to be coming back. We like pharmaceutical, where again the valuation seems to be kind of on a reasonable side. I would rather, even if I have to pay higher valuation, I would rather pay for at this point in time these kind of sectors than paying for the sector just we discussed with poor financials. So these are the very very interesting, and they have good growth. I mean, make no mistake, there is good growth. Economic growth of India, corporate profit growth of India it is robust. It is widespread. This year, probably, I feel there will be some amount of, in some segments pocket, there could be some amount of disappointment on earnings, but that is part of any kind of up and down cycle. Structurally speaking, with up boom, but so one has to keep in mind in times like this, in my opinion, portfolio should be more risk focused, risk conscious.
Themes which look exciting, I mean, what you're telling us are perhaps universal themes. For example, let's say I'm using a public information here. You've invested in Quick Heal. It's public information. A week ago, the world was hit by a virus. That means need for antivirus will suddenly come back. Another theme everybody is talking about post-budget is the land records have to be digitized. So suddenly there is a move in Proteon and Map My India. Anything which is niche, interesting, which could be like a nice sunrise sector?
I mean, what you mentioned that, like, absolutely, you actually hit the nail that, every market, there will always be opportunities. You have to look at it with a different lens, different, cybersecurity. I completely agree with you. It's a very, very big opportunity. And I can tell you 10 years down the line, 5 years down the line, we will see very big companies coming out of this. Now, which one will come out, only time will say. Even a lot of product oriented companies, which are kind of doing very well, growing very well. Historically, India has been only in the services where big companies came, but I do believe that many product oriented companies, are doing well. Like, again, it's a public information. Our portfolio company, Newgen, has done phenomenally well. And, for them, they are still very early stage. Can those companies, scale up in 5, 10 years, 15 years to a big size and scale? Answer is yes, because the product is ready, market is global. Indian markets have started spending. So look for those kind of businesses, stay invested. And if you have good management and those kind of businesses, if you overpay for some time also, it's fine. Doesn't matter, because the growth is very very high, and you will eventually come back because the growth will kind of make up for the initial valuation. But the fundamental of the business is, I would say, has to be very strong. Management quality has to be very strong.
Vikas, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
Thank you very much. Always pleasure talking to you.
If you like this video, then like, share and subscribe to ET Now.